Hello everyone, Mehdi Photocure Alpha Mine. And so today we're going to see that there's only 3 things you need to make money in the stock market. So this is part of the investing game. There are a lot of different types and a lot of different people in the investing game. But basically, if you want to make money, there's only 3 things you have to focus on, and that's what we're going to see today. And so it all comes down to one simple equation for the stock returns, and this is what we're going to deep dive today. So the first component is EPS growth, or earning per share growth. And actually, it's actually 2 components in one. So you have earning and earning per share. So what is earnings? Basically the profitability of the company and how much money on the bottom line a company can generate. And what is important for the return on your investment is basically how the company is going to be able to grow these earnings with time and how it can compound the money that it invests year after year. And then you have the earning per share, because what you own as a shareholders are shares. And what's important for you is that the level of earning per share is actually growing. And one key aspect of this element is basically dilution or buybacks. We can see a lot of companies doing buybacks recently. Actually, a lot of them are actually just compensating the stock distribution that they are doing to their employees. And so the key KPIs you have to look at is not really stock buybacks, but more the reduction of share outstanding. I think this is really a key differentiator between a lot of different content creators, because I think this is something which is not really well understood in the community, where a lot of different people are talking about buybacks, like a lot of companies doing enormous, well, as we can say, enormous amount of buybacks. But when you look at the share reduction in terms of return, it's actually pretty low for a lot of companies. I would say low single digits. And so this is actually a key component, and this is actually what is driving definitely the earning per share part of the EPS. But the main factor also as the earning per share obviously is earnings. So you have to find companies which are going to be able to compound earnings and grow that actually very significantly in the future. The second factor of this equation is basically valuation change. And what do we mean by valuation change? It's basically like the expansion or the decline or the decrease of valuation multiples. So I'm sure you have heard already a lot of different multiples that analysts and investors are using on a day-to-day basis, like P ratio, price to free cash flow ratio, price to operating cash flow ratio. But anyway, the point is that a lot of companies, they are valued based on multiples of some financial metrics. And the idea here is that this second factor is just looking at how people are looking at a certain or at your company in terms of valuation and how this perception is changing with time. So the more hope and the more expectation for a stock, the higher the valuation multiple are going to be. And this will actually lead to higher stock return going forward. But the most important point here is that how these valuation multiples are going to change in the future is going to affect your stock return. So if as a starting point you have very high stock multiples or valuation multiples, I would say, it's going to be very hard in the future to actually grow even further in terms of valuation. So that's why actually a lot of stocks, even though like they are growing revenues, they are growing earnings, you can see that with valuation contraction, they are not providing a lot of returns for shareholders. And so that's why companies like Palantir, for example, because I think it's a prime example of a company which has seen its valuation multiples increase significantly. So we have seen extraordinarily big returns in the last few years, but going forward, it's pretty uncertain and pretty unlikely that we're going to see extraordinary returns going forward. And why? Because those multiples are basically much too high or way too high for investors to continue to invest money in this type of stocks. So what we are most likely going to see is a contraction of the multiples for Palantir and definitely underperforming stock going forward. So the third point that you need to focus on is dividends, because as we've seen, so the return on stock investment is basically two things: capital gains and distributions. So dividend correspond to the distribution that a company is actually doing for its shareholders. And what you want in terms of shareholder returns is that as part of capital gain, but also as part of distribution and here dividends. So actually a lot of investors are focusing on this part because for them, like, it represents some kind of quality trades. And so this is part of the shareholder return. So definitely you should have a look at it and you should focus on it, because one key aspect of the dividend is that it's realized shareholder returns, meaning that the cash is returned to you, so you realize the return. Compared to valuation and EPS growth, where it's actually unrealized in the fact that it's just like a change of perception, so it's just price difference. But here, dividend is actually real cash that is given back to you, so you know that the return is realized and it's not going to change going forward, at least for this portion of the return. So this dividend return is actually the base of a whole movement of dividend investing. So you have dividend investing, which focuses more on the yield, but you also have dividend growth investing, which is focusing more on the growth of the distribution, which actually slightly different, but are two different movements which focuses on two different things and two different aspects of these companies. And so what I've learned is that you can make money in a lot of different ways. You don't need to actually be specialized in only one way. But the reality is that some ways actually fit better your own personality. Sometimes you are a bit more aggressive, so you may prefer growth stocks, or you may have maybe more specialization or more knowledge in some industries that are growing. You can also go into value stocks if you are more conservative and you are more able to recognize that there are dislocation in terms of financial value. So like in the financials, basically income statement, balance sheet, and cash flow statements, if we can say it like this. And you can also play it safe, like just compounding with like dividend stocks, even though I think that this strategy is a bit more defensive, but much more likely, I think, that to succeed in the long term. So this strategy, and what I've learned, is that you have to adjust to your own personality and to your own goal. There is no like one-fit-all strategy for like everybody. So that's why you need to learn, you need to try to invest, and you need to actually adapt your own strategy to your own personality and your own conditions. So now you have it. So the three key things you have to focus to make money on the stock market. So EPS growth, valuation, and dividends. And so this simple equation should really drive your investment process and the way you are looking at companies. So you may be more familiar with one or the other, but the thing is that you should check all your investment thesis and your investment process based on these three key things, and your investment is definitely going to improve significantly going forward. So if you're interested in other like concept like this one, or news from Asia or US stock market, so feel free to check my other videos and subscribe to this channel, and see you in another one. Bye.